Imagine a company like a giant cake. When a company needs money, it can cut this cake into small pieces and sell them. These pieces are called shares. People who buy these pieces become owners of the company. Each share represents a small portion of the company's ownership. When you buy a share, you become a shareholder. This means you have a tiny bit of ownership in that company. Owning a share also gives you certain rights. These rights can include voting on company decisions and receiving a portion of the company's profits. This share of profits given to shareholders is called a dividend. Companies need money to grow and expand their operations. They can get this money by issuing shares. When a company issues shares, it is essentially inviting people to invest in their business. Issuing shares is a way for companies to raise capital without taking on debt. Unlike loans, companies don't have to pay back the money raised from issuing shares. However, they do have to share a portion of their profits with shareholders. Companies can use the money raised from issuing shares for various reasons. These reasons include investing in new projects, expanding into new markets, or paying off existing debts. There are two main types of shares: equity shares and preference shares. Equity shares are the most common type of shares. They represent ownership in a company and give shareholders voting rights. Preference shares, on the other hand, offer some advantages over equity shares. Preference shareholders receive dividends before equity shareholders. They also have a higher claim on the company's assets if it goes bankrupt. However, preference shareholders usually don't have voting rights. Understanding the difference between these share types is important for investors. Companies can issue shares in two primary ways: through an initial public offering, or IPO, or a follow-on public offering, or FPO. An IPO is the first time a company offers its shares to the public. An IPO is a significant event for a company. It allows them to raise a large amount of capital. In an IPO, the company works with investment banks to determine the initial share price. After the IPO, the shares are traded on the stock exchange. This means people can buy and sell those shares freely in the open market.